So, you've probably heard the news. The Federal Reserve is signaling more rate cuts. Now, for a lot of retirees, that sounds less like good news and more like a direct threat to their nest egg. So what does that actually mean for your retirement? Let's break down this new financial reality and build a playbook for not just surviving, but actually thriving in it.
And right there, that's the big question, isn't it? The very same thing that's supposed to get the economy humming can feel like a direct hit to your own financial security. And it's got retirees everywhere asking themselves, is my game plan really built for this new world?
You see, it's a classic double-edged sword. On one hand, for the broader economy, cheaper borrowing is like pouring fuel on a fire. It encourages growth. But for you, the retiree, it squeezes those traditional safe sources of income. I mean, think about it. Your savings accounts, your CDs, they suddenly pay you next to nothing. And as your older, higher-paying bonds mature, you're forced to reinvest at these new, lower rates, which just grinds down the income engine of your portfolio.
Okay, so what does this all mean? It means the old playbook? It's broken. It's time to build a new one. And we're going to start right at the beginning with the absolute foundation of your retirement plan, your fixed income strategy.
Yep, that's right. Those days of just setting it and forgetting it with the conservative part of your portfolio, they're pretty much over. See, when rates are falling, being passive just means you're constantly locking in lower and lower returns every single time a bond matures. You've got to be more active now, more strategic.
Now, one of the most powerful ways to do this is something called a bond ladder. And I know it sounds complicated, but trust me, the idea is actually super simple. Instead of putting all your money into one big investment, you split it up into bonds that mature at different times. This gives you a really consistent cash flow. And, this is the key part, it stops you from having to reinvest all your cash at the exact same time, especially when rates are at rock bottom.
But it's not just about how you buy bonds. It's also about what bonds you're buying. They're not all the same. To build a much stronger foundation, you've got to look beyond just U.S. Treasuries. You know, high-quality corporate bonds can give you a little extra yield. And hey, if you're in a higher tax bracket, don't sleep on municipal bonds. The interest on those can often be completely tax-free.
All right, so we've shored up our foundation. Now it's time to talk about the fun part, the engine of your portfolio, the part that's going to give you the growth you need to outrun inflation. We're talking about the stock market. For retirees, this isn't about chasing the latest hot stock. It's about a disciplined hunt for quality. We're focusing on high-quality, dividend-paying stocks, but you have to know how to tell the difference between a solid, reliable company and a dangerous yield trap. A yield trap looks amazing on paper, a super high dividend, but it's almost always a sign that the company is in trouble. It's a classic case of, if it looks too good to be true, it probably is. Always look for a long track record of increasing dividends over time.
And this leads to a really important shift in how you think. It's not just about chasing that dividend payment. Real, long-term success comes from focusing on what's called total return. That's the combination of the stock price going up, that's your capital appreciation, plus the dividend income you collect along the way. A company that's consistently growing is usually a way better bet than one with a high but totally stagnant dividend.
And hey, if you're looking for other places to find income, you've got to look at alternatives like real estate investment trusts, or REITs. These are basically companies that own properties, and the law requires them to pay out most of their income as dividends. This makes them a really powerful tool for generating passive income, and they can also be a fantastic hedge against inflation.
Okay, so you've got the right investments. Great, but that's only half the battle. How you take money out, your withdrawal strategy, is just as important, maybe even more important, for making sure your nest egg lasts a lifetime. And believe me, I'm not exaggerating here. This is because of something called sequence of returns risk. Think about it. If the market tanks right when you retire and you're forced to sell stocks to pay your bills, you can do permanent, irreversible damage to your nest egg. That's why being strategic about this part is absolutely non-negotiable. So, what's the answer? One of the best strategies is the safe bucket. It's so simple, but it is incredibly powerful. You basically set aside 1 to 3 years' worth of your living expenses in things that are super safe, like cash or short-term bonds. All your bills get paid from this bucket. This lets your growth investments do their thing, riding out the market's ups and downs. It means you never have to sell your stocks at the absolute worst time just to pay the electric bill. Now, let's talk about one of the most powerful tools you have, and one of the only places you can find something like a guaranteed return: Social Security. Listen to this. For every single year you wait past your full retirement age to claim,
up to age 70. The government boosts your check by about 8% for life. That is a guaranteed inflation-adjusted return you just can't find anywhere else. And a bigger check from Social Security takes a ton of pressure off the rest of your portfolio.
And finally, we got to talk about the old 4% rule. Look, that rule was created when interest rates were way higher than they are today. Now, a lot of financial planners argue for a more conservative rate, maybe somewhere closer to 3.5% to be more sustainable. That doesn't mean the old rule is totally useless, but it does mean we have to be a lot more flexible.
So let's pull all of this together. The big takeaway here is that navigating this low-rate world isn't about taking on a bunch of crazy risks. It's about being smart, being deliberate, and building a plan that's truly resilient.
So here it is, your new playbook, plain and simple. First, rebuild that foundation with a bond ladder. Second, go hunting for growth, but focus on quality dividend stocks and that total return mindset. Third, build a defensive line for your portfolio with a safe bucket of cash. And fourth, maximize that guaranteed income for life by waiting to take Social Security for as long as you possibly can.
When you make these kinds of adjustments, you're not just hoping for the best, you're building a portfolio that can handle whatever comes next. So the real question you need to ask yourself is this: is your portfolio built for yesterday's rules, or is it ready for tomorrow's reality?